Mr. CA K S Ravi, who is the founder and senior partner of Mrs. Ravi and Sri Hari Chartered Accountants. He became an associate of the Institute of Chartered Accountants of India in 1990 and attained fellowship in 1995. He is highly committed to the auditing profession and has established high standards of practice in his firm. He had a vision to build a strong team and deliver professional services in all fields, including areas like accountancy, audit, taxation, both direct and indirect, costing, corporate law matters, international taxation, and business consultancy. He is also an eminent speaker who regularly delivers lectures in various institutions like Fiscal Policy Institute, Accountant General's Office, and Income Tax Department. He has been continuously delivering lectures at FPI, state government officials, for the past 5 years or so. He is a regular trainer on financial audit and social aspects for both governmental and non governmental organizations. He has been regularly providing advice and consultancy services on statutory matters to companies and institutions in the social sector for last 30 years. He is presently a financial and economic advisor to Vriksha World Foundation Bangalore, and his introduction never ends. So, without further ado, let us welcome CA K S Ravi to go forward with the webinar. Over to you, sir.
Thank you very much. So, thank you for the introduction. Am I audible to all of you? Am I audible?
Yes, sir. Yes, sir.
Yeah, okay, right. Thank you for the organizers. It's a great opportunity that I'm able to speak to the student community. I've always spoken to people who are very seniors. Now, I think I have to be a little slow because I'm talking to the student community. I am sensitive to that and I understand that. So let's start discussing issues. But the topic that was allotted to me was disclosures of disvaleances under the tax audit. Quite big. It's going to consume time. I could be a little fast, but if somebody wants me to slow down, then kindly prompt so that I'll be able to slow down when it is required. Because I have to cover a long list of things that are there under tax audit. Right. Now, first of all, tax audit, I'll try to deal a little with basics. I may not go deep into the basics, but then it requires. It's to ascertain compliance on one hand, and not normally, it has to be conducted only by chartered accountants. And the object of that is to support the income tax officials, so they don't have to go into the details, and they need to really understand the report and go by it, unless something is found to be not so good. So it is the responsibility of chartered accountants to ensure that the report that we give has to be to that standard and that level, and that sincerity has to creep in or step in whatever may be the type of work that we undertake. So we should try to understand this. Then tax authorities, it's going to save time for them, and therefore the responsibility on the chartered accountants is very high. I'll later on, if time permits, I will tell what practices are there which are not correct. And I'm very sure that I can speak this to the audience here, because that is not the type of practice that I've got into, and I've been very careful not to do things which is going to be questioned later. Right. So, scope of 44AB was enlarged. It also includes 44AD, where the turnover does not exceed 2 crores of an eligible business, transport business, plant and machinery on hire, prospecting, extraction, production of minerals, 44BB, operation of on hire, hiring of aircrafts, ships, civil constructions on turnkey projects, professional services. They all got added. That if you don't meet a particular criteria, you just have to fall into the tax audit and get your books audited. So exceeds 1 crore is what is stated there. But then they have now tweaked it to say that if your cash receipts and cash payments independently exceeds 5% of the set amount, all amounts, then in that case, you move to 10 crores of turnover for the purpose of tax audit. So 10 crores, which is there. And again, the issue is other sections are added, which I've already told you. Yeah. Then Section 36(1)(2) provides for deduction. Say, I've now come into the area where I have to talk to you today. That means with respect to what deductions are permitted, what deductions are not permitted. So therefore, I'm dealing with that clause by clause. So try to understand and you can raise questions when you really feel that something has to be explained more. It's to an employee. It provides by way of bonus or commission. Okay. So as bonus or commission for services rendered, where such sum would not have been payable to him as profit or dividend. Please understand that if it ought to be paid as profit or dividend and the business person tweaks it to say it's bonus or commission, we'll have to understand what is bonus, what is commission, what is the criteria for paying bonus or commission, or was it profit that ought to have been paid and therefore they enter into agreements which are really not true. That means substance will prevail over form. So therefore, we have to be very careful to understand whether it's profit or dividend, because first is tax is paid and only then profit or dividend is distributed. If it is bonus or commission, it's a charge on the profit and loss account. Therefore, the Supreme Court has said that it's very important to understand whether it was a bonus or commission or it was profit or dividend. And the tax auditors will have to really look into that very deeply to understand, because it's on the surface, it may look like bonus or commission. But if you understand the contract, if you understand who is the person who's getting it, you will come to know whether it's in the form of profit or not. Therefore, we have to be careful. There's a case law already there. Then I go to clause 20B. Amount received from employees to various funds. Be very careful. There has been a change with respect to amounts collected from employees. You have to be very, very careful. Because even the Karnataka High Court, we were arguing, stating that so long as it is paid within the due date for filing of return of income, we said even if it is an employee's contribution 43B, it's there. We look at that separately. But employees' contribution, Karnataka High Court had given this judgment. The income tax officer is not willing to accept that. We went on an appeal. Of course, it comes in our favor in appeal, but we are simply wasting our time, our maneuvers of the department. Because once you go to an appeal and the Karnataka High Court has given the decision, which is the jurisdictional High Court for Karnataka, in spite, they said, you please go for an appeal, you'll win the case. That we know. But why ever waste our time? They did not want to listen. But now have a look at it. Suppose you receive such money like ESI, PF, or any contribution to any fund. The Finance Act of 2021 has inserted explanation 5, which states that 5 to section 43B has clarified that provisions of section 43B are not applicable to sums received by the assessee from any of his employees to be. So what does it mean? In 43B, only employer's contribution will be allowed as a deduction, subject to the condition that it is paid on or before the due date of filing return of income. Now, this explanation says that if it is an employee's contribution, if you have not paid within the due date under the relevant acts, then the choice of trying to get a deduction with respect to this is not there. It will be treated as an income. Really, it's not an income because you collect it from employees and then you ought to pay it to the department, but then it will be a deemed income, taxable. The law has changed. You have to be careful. The way you argue for employer's contribution is not going to be the argument for employees' contribution. You'll get stuck because now all the court decisions will get dissolved by virtue of this change in the explanation. Therefore, we should be very careful about this. That's with respect to clause 20B, it will get disallowed. Then, now I'll talk about these type of clauses generally now and then get into the specifics a little later. One by one, I will deal with them. But first, let's understand what are the clauses that are available for the purpose of having a bird's eye view of dissonances. Capital expenditure, personal and advertisement expenditure, etc. are not allowed. What's the issue? Capital expenditure, we know, will not be allowed at all. It has to be capitalized. And if at all it has got the capacity of claiming a depreciation, it goes under that. Personal expenditure, not allowed. Advertisement expenditure, any souvenir, brochure, tract, pamphlet, or the like, published by a political party. I will explain that a little later. What is political party and what is something else other than a political party. Then expenditure incurred at clubs being entrance fees and subscriptions. Here, not only will I explain, but there are mistakes at the time of filing information relating to this. There's a review which has been made with respect to many tax audit reports, and the institute has come out with some of the review remarks of where things can go wrong. I'll deal with that if time permits as a last item. Then, expenditure incurred at clubs being cost for club services and facilities. Look at this. This is what is the issue. Here you got expenditure incurred at clubs being entrance fees and subscriptions is one issue. Then expenditure incurred at clubs being cost of club service and facilities. People tend to club both of them. Not permitted. Your format asks you for details separately for these issues. Why are we clubbing and giving one figure there? That means our working paper does not contain the bifurcation between these two. So one should be very clear to understand the intent of anything that has been asked in any clause. Read the clause very carefully, understand the language very carefully, and then try to prepare the working paper so that you can feed it correctly. There's nothing wrong, there's nothing that has gone wrong. But the problem is when the format is asking you a specific detail, kindly go down, drill down, and get those details, put that on your working paper and use it to present the information. Expenditure by way of penalty or fine. Again, you have a problem. People club both penalty and fine. Okay. Now, what is penalty? What is fine? If it is fine, it is more, does not have a criminal tinge. If it's a penalty, it could have a criminal tinge. So you must try to understand when is it a fine, when is it a penalty, when is it a late fee. So therefore, there must be a clear bifurcation between penalty and fine, and they want you to give those details separately, penalty or fine to be given separately. Expenditure by way of any other penalty or fine, see, look at that again. One is specific penalty and fine. Then the other is, which is generally there, but may not be. For example, let us say that there are people who are getting caught by the police for violation of, that could not be anything to do with business, but it has happened as an event. Then you have to bifurcate between those which relate to business and those which does not relate to business. Then expenditure incurred for any purpose, which is an offense or which is prohibited by law. You see, you got fee, you got penalty, you got fine, then you got an offense. Expenditure incurred for a purpose which is an offense or which is prohibited by law. You look, is it a penalty? No, it could be any other expenditure. So therefore, that bifurcation is required. It may neither be a penalty nor be a fine, but it could be an expenditure incurred for that purpose. And therefore, we have to be able to distinguish between these words very carefully. We tend to fill up details because we are in a hurry. We don't know where we are putting in, what slot we are putting. The problem is that we should be able to sit down and understand what is the question, what are the data that is available to us, and how are we going to fill that. Then we will know how it goes about. Then you come to amounts in section 40A, clause 21B. What is this? I talked about 21A. Now I'm coming to 21B. 40A1. Any interest on loan, royalty, fees for technical services, other sums payable outside India or in India to a non-resident without deducting tax at source, or tax having been deducted has not been paid. Please understand, the provision of 30% disallowance is applicable only for domestic TDS not being done. But with respect to international transactions, whole of the amount so paid and will be allowed when such TDS is paid in any subsequent year. Whole will be not allowed at all. It will be allowed only in the year in which TDS is paid. So one has to keep a control with respect to take that benefit of deduction. Will be allowed in the same year if the payment is made before the due date of filing return of income. So if you have not done that, but if you pay it along with interest before the filing of return, you will still be allowed in the same year, though it is done in a subsequent year. But if you don't do it before filing return of income, then it goes to the subsequent year and the deduction will be allowed in that particular year. That's one of the ways of looking at it. Then 40A IA, deduction of tax is not made from payments to residents or is made but not paid. 30% of the payments so made will be disallowed and will be allowed in the year in which the payment is made. But if it is done before filing the return of income, then it will still be allowed for the same financial year. Then 40A IC, any sum paid on account of fringe benefit tax, whole of the amount, let's not worry, no longer relevant. Then 40A2, any sum paid on account of any rate of tax levied on the profits or gains of any business or profession, or assessed at a proportion of, or otherwise on the basis of any such profits or gains, any sum paid without deducting tax at source, either under section 90, 91, 90A, whole of that amount will be disallowed. It will be allowed. See, they did not even talk about whether you can pay it before due date of filing return and whether you can pay it in subsequent years. Here they stopped and they said whole of that amount. Then any sum paid on account of wealth tax, not applicable. Let's not worry, but it's still there as part of the tax audit requirement. Then paid by way of royalty, license fee, service fee, privilege fee, service charge, or any other fee or charge by whatever name called, which is levied exclusively. Okay, any payment of 1 minute. Exclusively or how do I? Just a minute. Okay. Just a minute. The sun of market so that we can come back. Okay. Come out. Okay. Just a minute. Any no top. Okay. Top. Okay. Look at this. Paid by way of royalty, license fee, service fee, privilege fee, service charge, or any other fee or charge by whatever name called, which is levied exclusively on, or which is appropriated directly or indirectly from a state government undertaking by the state government. Please understand, anybody who is doing PSU audit, please understand, if there is any payment made, for example, royalty, yeah, PSU will pay royalty, license fee can be paid, service fee. If it is paid to the state government, whole of that amount will be disallowed. How many of us are aware of this is difficult to understand, because I have seen certain tax audit reports where payment made to state government, because the intention is whatever is paid to the state government earns a revenue at the cost of the central government. Therefore, they say disallow that. That's the intention. Therefore, we have to be careful. And I've seen a lot of tax audits where this is not being looked into. They say not applicable or not available or something like that. There are few tax audit reports where they have really taken this into consideration. Right. Now we go to the next one. 40A3. Any payment which is chargeable in rate salaries, if it is payable. Look at this. We already talked about 90, 91, 90A and all that. Here, salaries, if it is payable outside India or to a non-resident, and if the tax has not been paid thereon, not deducted therefrom under chapter 17B, all of the amount, no relief if subsequent payment is made, unlike 40A1, 40A1A. Look at that. So that means you have to do it. If you don't do it, even subsequently if you do it, so normally what people do is, wherever you don't get any relief, they don't go to pay the tax at all. They just allow it to, they forgo that. Only where you get a relief, you go and pay it and then take it in that year. Then any payment to a provident or other fund, look at this very carefully. Any payment to a provident or other fund established for the benefit of employees of the SSC, unless the SSC has made effective arrangements to secure the tax, shall be deducted source from any payments made from the fund which are chargeable to tax under head salaries. Did you understand this? Look at this. Payment of provident fund, superannuation fund, gratuity fund. Now, when can those get taxed, if you ask me that? If it is not a recognized provident fund, or they have not taken permission from Commissioner of Income Tax to set up the trust, then in that case, anything that is transferred, merely at the time of transfer, nothing may happen. But if it is going to be paid to the employee and no arrangement, because it has to get taxed, the tax has to get deducted. It has to definitely get deducted. Reason being that this is not a recognized provident fund or not an approved superannuation fund. If those things are there, if you don't do tax deduction, you get relief only if it is public provident fund, recognized provident fund, all that. Therefore, permission from Commission of Income Tax, all the tax auditors will have to see whether that particular permission is there and whether it's eligible for transferring the funds to such type of trust, all that, and then take a stand. And therefore, we need, one is the evidences that we can get from the books of accounts, asking for documents, then a written representation also may be required to understand the concept very clearly, right? Then any tax actually paid by an employer referred to in 10cc of section 10. That means you give non-monetary benefits to an employee and then you don't deduct tax at source, because non-monetary benefits 194R will apply to all other transactions other than employees, especially with respect to non-monetary. There 10cc gives that it is not a perquisition in the hand of employee when it is not in the form of non-monetary benefit. Now there the question is, the employer decides to pay the tax on that behalf. Employee should have been paid, but employer will gross it up and pay tax accordingly on that. If that is the case, then whole of the amount paid by the employer on behalf of the employee, that means the tax so paid will get disallowed. Just like income tax being disallowed, or all the similarly tax paid on behalf of the employee with respect to where 10cc is available, there again it will get disallowed, and you have to seek for that information where tax has been paid on behalf of the employee. Salary paid to partners, we know that on the first 3 lakhs, 90% or rupees 1,50,000, whichever is higher, and on the balance at the rate of 60%. Section 10 provision, therefore, you will have to report on this particular issue. Then interest, salary, bonus, commission or remuneration paid to a member. Member of what? Of any association of persons, AOP. B is with respect to partnership firm. And if the partnership firm loses the character of a partnership firm, becomes an AOP, or any other AOP like trust, society, wherever 12A and 80G and all that is not there. If interest, salary, bonus, commission or remuneration paid to a member of that particular association, whole of that amount will get disallowed. So we need, suppose you are doing audit of AOP, you'll have to look into this aspect as well. Then with respect to TDS not done, what are the details that you have to maintain? What is the date of payment? Payment means the gross amount that you pay to the contractor or to professional or whatever, date of payment. Then amount of payment, nature of payment, that's what. Under what section of 194 or 192 are you looking at that nature of payment? Name and address of the PE. If tax is deducted and not paid, amount of tax deducted, tax has been deducted. So therefore, amount of tax deducted, date on which it was actually deposited, if there's a delayed payment. All these details will have to be given in the tax audit report. Therefore, our working papers will have to contain all these details to find out what exactly is the type of information we have to give. Now, I come to clause 21D. More of it, I'll explain it in different slides. I'm just giving you the bird's eye view of what is actually the provision and how to deal with that when practical issues come up. We know this 40A3 and 3A, read with rule 6DD. What does it say? Any payment in excess of 10,000 to a person in a day. Please look at all the words. Expenditure covered under section 43 is more than rupees 10,000 to a person in a day. These are 3 issues that has to be looked into. Read with rule 6DD. Why are we reading it? It is so clear. No, there are provisions in rule 6DD where payment can still be made beyond 10,000, but it will not get disallowed under certain circumstances, which I'll give you the details of, which are those that people can come out of this 48A stringent provisions. Okay, drawn on a bank or account payee bank draft. It must be a crossed account payee check or an account payee bank draft, or presently all these things have been introduced, use of electronic clearing system through a bank account or through such other electronic mode as may be prescribed. What has been prescribed also, I'll give you the details. 40A3A. Now for general purposes, 10,000 is the limit, but for hiring, flying or leasing goods carriages, it will be 35,000. What are the details that you have to collect? Suppose they transgress this provision, it will ask for date of payment, nature of payment, amount, name, PAN number, Aadhaar number, if available. You'll have to give. There may be a possibility that people will have Aadhaar number, may not have PAN. I've seen that. Aadhaar, because a lot of benefits are given through Aadhaar, therefore, generally, we may still get Aadhaar number. Then I've cleared all the 21, no, I is there. Okay, 21E. We come to 21E, provision for payment of gratuity, not allowable under section 40A7 until it is actually paid. 21F, any sum paid by the assessee as an employer, not allowable under section 40A9. Any sum paid by the assessee as an employer, not allowable under section 40A9. That means there are a lot of payments where you give it to your relatives or people who are related parties. Those things, if the assessing authority believes that is in excess of what should reasonably be paid, it will get disallowed. Then particulars of any liability of a contingent nature, tendency is that contingent liability sometimes will get included as a liability or as a provision. We should try to understand these three terms: contingent liability, then what is a provision, what's an actual liability, and I'll describe that as we go ahead. Then amount of deduction inadmissible in terms of section 14A in respect of expenditure incurred in relation to income which does not form part of the total income. 14A, all your section 10 provisions, 10A, 10B, all of them will not, especially section 10 provisions will not form. But if you incur any expenditure relating to that, section 14A says, since the income is not being taxed, and probably some of them will not be included in income at all, any expenditure included and debited to profit and loss account will be disallowed. Then 21I, amount individual in section 3613, that means where it is not treated as a business income and there are disallowances in 3613, those things will also have to be taken into consideration. For 3613, for example, PF is one of the issues, employees PF, right? So now I'm going to go and then explain to you each of those what I've discussed already. Quickly, I'll go through that so that we can move into the other clauses. What is the object of clause 21? 21 A, B, C, D goes up to I. It may be allowable or may not be allowable. Both are there. One is it is not allowable at all. That's one answer. Another is may be allowable subject to fulfilling of certain conditions. Clause 21 speaks of this. Therefore, you should be clear. When is it allowable? When it is not allowable at all. Allowable at all. So therefore, we have to really read the issues very carefully to understand what is allowable and what is not allowable. It's important to note that the amount of expenditure in respect of each of the items is required to be stated. How should it be stated? In the format that they've asked for. Therefore, your working papers will have to contain all that you're going to feed into the annexure to the tax audit report. Accordingly, tax audit will have to obtain the information and make necessary inquiries in their behalf. It will necessitate verification of books of accounts and other relevant documents, basis of classification, groups under which such expenses have been debited, and so on and so forth. You will have to have all those details, because at the time that somebody asks you for those details, you must be in a position to produce that to satisfy that the audit has been done according to the requirements of law. 21A, what are the issues that you're going to look at? The case of the payer has to be considered independently based on the facts concerning him, as it may be a revenue receipt in the hands of the recipient and may be a capital in the nature of the payer. See, it can be a revenue receipt in the hands of the payee. I don't look at it what happens in the payee's hands. I have to look at it from the point of view of the payer. Therefore, be very careful to look at the books of the payer, whether it's a capital expenditure or a revenue expenditure, and don't look at it from the point of view of the payee. That's an important issue, because you can go on interpreting. For example, let us say plant and machinery. Normally, we treat that as property, plant and equipment. But for the person who is going to actually sell plant and machinery, it's going to be a revenue item. So therefore, look at it from the point of view of the payer. That's the first condition. Then, capital expenditure on scientific research may be allowable under section 35, but the same should not be debited to P&L account. It is not the question of whether it's in P&L account or in balance sheet. Please understand that. You don't. It's a computation issue. And your accounting treatment cannot change just because the income tax the act is asking you something else. Kindly don't debit any of the capital expenditure into the P&L account. You have to take it into the balance sheet and use it in the part of computation. Your depreciation will go on as usual if you're claiming under the company law or any other law for the time being in force. But then, for the purpose of income tax, you will have to recompute whatever you are doing from time to time. Well, it's an item of balance sheet as per accounting requirements, and therefore, its treatment per se is done in the computation of income, and you cannot alter your profit and loss account. If at all it is debited to P&L account, the tax auditor requires to qualify it in his report. Please understand what you mean by qualification. 3CD is an annexure to your audit report. Now, here there is going to be a digression from the requirements of the accounting standards, accounting requirements. Therefore, the qualification will have to come in the tax auditor's report, either in 3CA or 3CB. That is what it means to qualify the report, right? Merely including it in the annexure is not enough. It has to come as part of the report because it is significant. Preliminary expenses incurred by the SSC, which is capital expenditure, is debited to profit and loss account and therefore should be reported. See, lot of us debit preliminary expenses, which is a capital expenditure, still into the profit and loss account. If that is so, then in which case, kindly report, though it is debited to, it's not an expense, it's a capital expenditure to be recovered over a period of time. But the income tax law speaks of one language, and um, the Companies Act or other law speaks of another language. Therefore, you may have to report this, and many people have not reported preliminary expenses in many of the tax audit reports. They just go and then use it in the computation without reporting it, right? Expenditure of personal nature. Personal expenses debited to profit and loss account. I don't have to define what a personal expense is. So long as it is not related to business, so long as there is some benefit that is taken out of business, which is of a personal nature, they are not allowed to be deducted at all. That is what is section 37 I was talking about. They don't allow. It may be noted that the word personal is confined to and attached with the SSC only, and not necessarily to and with persons other than the SSC. Please understand. When you talk about, I can really look at the managing director who's not the shareholder of the company. Some personal expenses are debited. Maybe that's part of his the arrangement that we have got as an employee, and we are giving those benefits which will be treated as part of salary. Now, is it a personal expenditure? Yes, it may be a personal expenditure as far as the employee is concerned, but it is not a personal expenditure to be reported in tax audit report because it talks of personal expenditure of the SSC only, in which case companies per se should not have any personal expenditure other than of employees where there is no permission or there is no contact for making such payments to them. If that is the case, that will get disallowed. It must be according to the terms of the contract. It should be treated as part of salary or perquisites and accordingly taxed. Section 143(1) of the Companies Act 2000 also requires this comment from the auditor. So what has happened? You have this in your Companies Act report, because sometimes if the statutory auditor is different and the tax auditor is different, you don't look at what the statutory auditor has done, then probably you miss this point and it may not contain it in the tax audit report, which will show differences between the report given by the statutory auditor and that of the tax auditor. Take care. Always keep looking at what is there in the statutory audit report to be able to say what can get covered under the tax audit report. So what do you want? Nature of and particulars of expenditure, what you believe to be personal in nature, account head to which it is debited, amount of expenditure. So what does it mean? You have to go through all the account heads to be able to understand if there's any personal expenditure in any of them, right? To the extent possible, whatever is the audit method, please try to identify that. And if you get some instances, probably you have to go deep to understand this. And nature and particulars of expenditure has to be explained. Advertisement in any souvenir, brochure, tract, pamphlet, or other like published by a political party. What have you to look at that? Section 37(2)(b) disallows expenditure of the above nature. The trade union or labor union, though promoted or formed by a political party, may have a distinct legal entity. Take care. Therefore, no disclosure is required under clause 21A. This is the uh, thing that you eliminate. You should not treat that as, though it may have been formed, but if it is not going to serve the interest of a political party and stands independent, then this disclosure is not required. The auditor may also keep in mind the provisions of section 80 GGB, 80 GGC, which allow deduction in respect of contribution made by corporate and non-corporate respectively to political parties and electoral trust as required to be reported in clause 33. Look at that. Electoral bonds, which are now permitted, that has to be reported in clause 33 of form number 3CD, and it should not come here as part of 21. So therefore, you must try to understand what should fall into a particular clause. Not that we understand political party and there is some contribution made that I have to put it in 21A. No, that is not the method. Method is find out what else and where else can something be placed. Whichever is more appropriate is what you have to choose, and therefore selection of the clause becomes very important at the time of disclosure. Then expenditure incurred at clubs being cost for club services and facilities used, entrance fees and subscriptions. The amount of payments made to clubs by the SSC during the year being cost of club services and facilities used should be indicated under this clause. The payments may be for entrance fees as well as for membership subscription and for catering and other services. The fact whether such expenses are incurred in the course of business or whether they are of personal nature should be ascertained. Very important. How do you ascertain that? You will have to take things in writing so that it forms part of your working paper. If they are in personal nature, they are to be shown separately under clause 21A. And apart from that, it's asking distinction between services on one hand, entrance fees and subscriptions on the other. Therefore, try to give that separately. Okay. See, they're asking here itself. Entrance and admission fees is one. Cost of facilities another. Your working paper should contain that so that you fill the tax audit report and a 3CD annexure to the tax audit report appropriately. Then expenditure by way of penalty or fine for violation of any law prohibited by law. Violation of any law prohibited by law. Two things that they're talking about. There's a law which exists and you violate that. What is violation? For example, you should have gone on the left side of the road, you're going on to the right side, that's a violation. No entry place, it's a violation. Prohibited by law, you're not supposed to do that at all. You can't smuggle goods, that's prohibited law. So distinction between violation of law and prohibited by law has to be kept correctly in your working papers. The tax auditor should obtain writing from the SSC. Very important. Lot of things you have to get it in writing. You may understand. You may take a particular stand. But tomorrow the SSC can come back and ask, who told you that this is correct? It is not correct. So better would be to dialogue, take it in writing so that you can justify your stand that the SSC has accepted this particular, whatever presentation has been made by the tax auditor has been accepted by the SSC, and there you may disagree. But having disagreed, he can say what he wants to say. You can overrule that. But then it must be a conscious effort of overruling the contents of the tax audit report. Therefore, one has to be careful. Then we also talk about how it has been dealt in the books of accounts. That means where has it been placed, which account head, is it an expenditure or is going to reduce an income, any of those things. Or has it gone to debit the customer or the supplier? All those issues has to be discussed for any purpose which is an offense under or which is prohibited by any law for the timing in force in India or outside India also included. Please take that into consideration. Or to provide any benefit or perquisites in whatever form to a person, whether or not carrying on a business or exercising profession, it is in violation of any law or rule or regulation or guideline. This I don't have to speak much. It is rampant across in this country. And though we recognize, we still keep our eyes, ears, and mouth shut. Mahatma Gandhi comes into position. Then, to compound an offense in India or outside India, yes. Compounding, you are getting out of a violation, you are getting out of a prohibition with respect to any law in India, and therefore the compounding of an offense is also to be stated, and that has to be looked where exactly it is debited. Expenditure by a penalty or fine for violation of it continues further. It must be borne in mind that the tax auditor, while reporting under this clause, is not required to express any opinion. Please be very clear. You just have to pull out that and then make a statement, opinion as to the allowability or otherwise. It may be allowable, it may not be allowable. That's not our job. Our job is to cull out that information, put that into the required format. That means you must strongly believe that this has to be reported and report. It will get allowed, it will not get allowed. Computation, they're going to change. All that, it is left to them. The tax auditor should keep in mind the difference between the amount prohibited by law and the amount paid, which is compensatory in nature, very, very clear. For example, let's take liquidated damages or interest paid on violation of some amounts to be paid. They are all compensatory in nature, and that cannot be a violation. That cannot be a provision of law. So Supreme Court in Mahalakshmi Sugars has stated that there is a distinction between amount paid by the assessee as compensatory in nature, that which compensates. Had I got this money, I would have got interest, and that interest has not been paid. Please pay that interest. That's compensatory in nature. Okay? Or penal in nature. Penal in nature is a penalty, a fine, and only amounts paid in penal nature will not be available. But if interest paid as a compensatory issue, liquidated damages paid as compensatory issue, all of them will be allowed. And therefore, reporting of that would not be required under this particular clause. Again, this particular issue regarding penalty and prohibition by law, fines, all that, Circular 722 dated 23/12/1998, the CBDT has given retrospective effect from 1962-63 regarding this particular issue. One can go into that and have a look. It's exhaustive. In addition, 40A1A, I've already discussed non-resident payments without TDS. Then payments to residents without TDS. On the fund one, whole of the amount in the case of non-residents will be disallowed. But in the case of residents, 30% of whatever has been paid will be allowed. Sorry, will be disallowed. And whenever payments are made, both for non-residents as well as for residents, it will be allowed as a deduction. Then you have one more issue. Interest payments to MSME vendors are covered under the provisions of section 197A. And the auditor should take care to ensure that the deduction of tax at source has been complied with or report the same under this particular clause. Okay. So interest paid. First is are covered under the provisions of 197A, and the auditor should take care to ensure the deduction of tax at source has to be made. Okay. If that is done. One more thing we should try to understand, that with respect to interest payment to MSME vendors, it will not be an allowable expenditure in section 23. Therefore, even if I'm going to deduct tax, but otherwise it's necessary for the tax auditor to specify, right? Whether the interest is going to be allowed, not allowed is secondary. There was a need for deducting tax at source, and that too needs to be reported under this particular clause. Details of payment on which tax has been deducted but has not been paid during the previous year. That again, deducted but not paid. The consequence of that is higher rate of interest, but then you have to give details. As and when it is paid, it will be allowed. Otherwise, it will not be allowed. And if it is paid before the due date of filing return, any of them that we have talked about will still be allowed. And those details are also have to be carried. Then I've already discussed this issue. Any amount paid by way of royalty, license fee paid to state government, public undertaking, not others. Please understand that any private party paying, it's an allowable expenditure. But a public sector undertaking paying to the government will not be allowed, because it amounts to that what ought to have gone as a revenue to the central government is going to be taken away by the state government. So they don't allow that to happen. 21B5. Salary paid is paid outside India or to the non-resident in India. I've already told you that unless you pay, has not been paid after deduction, the same is not allowed as deduction under section 48(3). Same is required to be reported. Now is not going to be paid, is not going to be allowed. That's all. You just have to report. Has not been paid after deduction, same is not allowed as a deduction under section 48(3). Not allowed. Again, it doesn't come back for allowability once the payment is made. What is not going to be allowed? People may not deduct tax at source because they say anyway it is disallowed. That could be one of the issues, but the tax auditor will have to take into consideration and report this, whether the expenditure is going to be allowed or not going to be allowed. We still have to report it. Then I've already told you, any payment to a provident fund or other fund established for the benefit of employees, that which is not registered, at the time that it is going to be made, payment is going to be made, because you have funds available with you only. You are not parted with it. It has not gone away from you. If that is the case, and if it is unrecognized or you don't have approval, then all of them will not be allowed, whether at the time of payment or at the time of making a provision. Any tax paid, that is one thing. Then other thing is that non-monetary purposes, 1010 CC, which I already told you, that the tax has to be paid by the employer according to give that exemption to the employee. The employer has to pay the tax, and the tax so paid will not be allowed. That has to be reported by the tax auditor. Then what happens now? With all this that I've discussed, there could be a difference of opinion between the assessor and the tax auditor. That's what happens. If you really do a serious job, they may not like it. I'll give you one example. We had an issue regarding that MSME vendors were not identified, details were not given, interest provision was not made, and they put it under normal vendors, telling that they don't have the information. Then we said we'll qualify the report, and then it is for you to decide whether you want to give the details or not give the details. The audit got postponed. They spent some time and they gave the details, bifurcated it, because once you ask them to put that down in writing, first issue, and then you qualify the report and ask them to apply their mind, immediately they'll come back with all the details. At least that is my experience. You qualify the report and leave it. Many people do not want. I will tell you, one more issue is that there is qualification and nobody is affected. Even if people are affected or not affected, businesses are affected or not affected, it is our job to qualify the report where required. Then what happens? Either the assessee takes a proactive step to give you the details and you can close by removing that qualification. Otherwise, it continues and something may happen or may not happen. That's not what we have to discuss. We just have to report. So in case of any difference of opinion between the tax auditor and the assessee, the tax auditor should state both the viewpoints. Just don't make your own viewpoint. You have a viewpoint. The assessee too has a viewpoint. Please express both of them. That's an important issue when there is a tussle between the assessee and the tax auditor. In case of voluminous nature of information, the tax auditor can apply materiality principles, test checks and compliance tests for verifying the information required to be provided in this clause, that is clause 21B. So take care that our audit principles will have to apply. How much to do, to what extent to do, then state how have you done that particular audit, what type of qualification you have to put up. Then how do you want to restrict yourself to say, I could not have done that exhaustively, but whatever little that I've done through my test check basis or by materiality principles, I've reported. And that you have to make a statement so that the reader knows on what principles have you completed the audit, right? So I go to 21C, amount debited to profit and loss account, interest, salary, bonus, commission or remuneration, 40B and 40BA. 40B relates to partnership firms, section 10. 40BA, association of persons, where you can't pay. Because even partnership firm, by virtue of any technical fault, moves into an AOP, salaries, interest, everything that you have paid. Or if it is not in accordance with the terms of the partnership deed, again you have a problem because CBDT has come out with a circular with effect from, if I understand it right, 96, 97 assessment year and onwards. You have to specify what is the quantum of salary to be paid to partners. Or you would also, otherwise you must suggest a method of how the quantum is to be determined. It has to be in the partnership deed. Otherwise the partnership deed fails for the purpose of income tax and you may fall into an AOP 1. Second is, suppose interest is paid on capital current account more than 12%. All that you have to do is show that, and anything beyond that 12% will get disallowed. And it must be in the contents of the partnership deed to pay this one. So these are some of the issues. So in working out inadmissible amount, the tax auditor must have due regard to the circular number 739 dated 96 issued by CBDT. So that's an important issue. So therefore take care, have your computation in your working papers and then report accordingly. So what is book profits? Because you're going to work out your 90%, 60%, all that on book profits. So explanation 3 to section 40B provides that book profits means the net profit as shown in the profit and loss account for the relevant previous year, computed in the manner laid down in 4D as increased by, say, what is 4D? As increased by the aggregate amount of remuneration paid or payable to all the partners. That means if you have debited profit and loss account, add that back to the income that has been arrived, add that back, partners of the firm. If such amount has been deducted while computing the net profit, if you have done that, add it back. The inadmissible amount of salary, bonus, commission, or remuneration is to be worked out after deducting interest allowable to partners as per the provision section 40B, which is 12%. Allow that. Then rest of it will be disallowed. Then start your computation. Keep this working paper tight. So verification of computation of inadmissible amount. Not that you have to work. If you don't want to work, ask them to work and then give you. Then it is for you to really look into that computation. Normally, the thing is, many of them don't understand how to compute this. That's the first issue. In which case, probably we have to have our working paper according to what we want and tell them this is how it has been done. Sometimes big firms have the capacity to do it and they do it. So what is the tax auditor to have? What has the tax auditor to do? He has to verify the computation from the instrument or agreement. The problem with all of us is that the very basic document like a memorandum of association, articles of association, bylaws, partnership deed is never seen. Never seen. You have to see it year after year because there is a possibility that some of them could have changed. We just get into the audit without having the basic documents in our hand. I've seen that. Object clause has remained different from what the company is doing because first it was a software company, then it was taken over for distribution of medicines. Object clause has not been changed for the last 10 years. Suddenly somebody woke up and then said the object clause does not match with the business that has been undertaken. Because it was a taken over company and nobody even bothered to look at that object clause of memorandum of association. Please have those documents year after year after year. Question that. A lot of places rent agreements are not even renewed and we still accept that. And we don't even want to mention that in the letter of weakness. So therefore, take care. Your documentation is an important issue. Lot of things come out because you ask for a document. Under section 40B4, any payment of interest to any partner which is authorized by and is in accordance with the terms of partnership deed alone is allowed, and it must be at the rate specified there, and it cannot go beyond 12%. All these issues have to be looked into, and therefore, and whenever the constitution of partners change, some of these paragraphs also get deleted without knowledge, ignorantly, and we don't even look into that, and therefore we have to be very careful. Sometimes it so happens that the salaries paid is much more on the assumption that the partnership deed has taken care of that, but there would not have been any change, and therefore you have to compute this very carefully and keep that in your working papers. Section 40BA, it's relating to association of persons, nature of payment to the partner member. Section 40B, 40BA, both of them they're asking. So put that into different columns if you want. Amount debited to profit and loss account, amount admissible, amount inadmissible, and remarks. See, these are the ways that we try to capture data and keep it so that it will be easy to answer the queries that are there in 3CD. Deemed income, 40A3, read with rule 6DD. So, for expenses exceeding rupees 10,000 per day and for plying, hiring or leasing goods carriage, rupees 35,000 per day to a person. Having regard to the nature and extent of banking facilities available. See, rule 6DD will give you this. Having regard to the nature and extent of banking facilities available, consideration of business expediency and other relevant factors, no decision shall be made. That's what the courts have held. And therefore, if the assessee has got something to say, please make a note of it in your working papers, whether to express it or not, because we don't express an opinion. We simply have to give facts. And therefore, to express it or not is left to the tax auditor. But I would simply say, please put down in the statement, included in the tax audit report. It's for the assessee to fight it out later the way he wants. What are the other mitigating circumstances? Rule 6DD, it says all this. Payment to specified entities engaged in banking and insurance activities. This question of 10,000 or 35,000. 35,000 will not apply for banking and insurance. It's only 10,000. Payment to government when required to be made in legal tender. Payments through banking channels with use of bill of exchange, book adjustment, transfers. Payments to specified growers, cultivators, agriculturists, to contact industry, etc., to cottage industry, etc. Payment in village not served by a bank to resident of such place. Payments of specified terminal benefits to employees up to rupees 50,000. Payment to agent who is required to make payment in cash. If you get all this, you will be in a position to say it does not come under the purview of this particular clause. Payment by authorized dealer for purchase of foreign currency, etc. Now, my statement is irrespective, you still have to include that in this particular statement and then say that there is an exemption or there is a mitigating factor in Rule 6DD is all that you can state. Then electronic modes of payment permitted: credit card, debit card, net banking, immediate payment service, unified payments interface, real-time gross settlement, national electronic fund transfer, NEFT, then Bharat interface for money, BHIM, Aadhaar Pay. These are all permitted, and therefore provisions of this clause or Rule 6DD will not apply if you have transacted by this method. If the transactions are voluminous, you will have to do anyway. This test check or verifying on materiality and all that you have to do. But ultimately, if you are fully not satisfied that you have not been able to do a thorough job of that, then you have to state, it is not possible for me or us to verify whether the receipt payments have been accepted, made otherwise than by an account pay check or an account pay bank draft or use of electronic clearing system through a bank account or through such other electronic mode as may be prescribed. As necessary evidence is not in the position of the SSE, maybe. Because he says cross-check. You don't know what are the methods and control for it to be a cross-check. It is gone. And it has come into the bank account also. In spite, I will not be able to tell whether it was a crossed account pay check or not. Therefore, if you still have any reservation, kindly state. It is just that a format has been given, but that's okay. You can state the way you want to state. Kindly keep that in your mind. There is a possibility of using of an audit tool. In the current softwares, you will be able to look at it. And also obtaining a certificate from the SSE are other possibilities that you should explore to get a documentary evidence for this. Because you can dialogue. A lot of things you have to dialogue. You can't take things for granted because the accounts and the business relates to that of the SSE. You are only an umpire, and therefore you need to get proper information before you make a judgment. 21E, items of expenditure in respect of which specific exemption has been given under clauses A to L of Rule 60D are not required to be stated under this clause. Don't even state. If you still want to be safe, state it, but then say Rule 60D provides for this exemption. Then payment of gratuity not allowable under Section 40A7. The tax auditor should be aware that contributions made to approved gratuity fund and gratuity paid or payable on which no deduction has been claimed earlier are mutually exclusive. Each one of them are different. Please note that the tax auditor should be aware that contributions made to approved gratuity fund and gratuity paid or payable on which no deduction has been claimed earlier are mutually exclusive. That means if you make any payment to an approved gratuity fund that is approved by the Commission of Income Tax, then that will be an expenditure allowed. But if it is paid or what is paid is also allowable, whichever financial year you are paid, what has gone into the gratuity fund, you just have to forget about it because you have no control on that. Even if it is a trust, because it's an approved gratuity fund, or you are trying to do it with LIC or something like that, again, you don't have to worry. The year in which you make the payment, it just is allowed as it. Suppose, let us say you are having a payable or you got an actuarial valuation for which no investments are made and you want to pay. The year of payment, you will get that deduction. If it is simply payable, take it from me. It's mutually exclusive, cannot be treated as an expenditure. Though it's expenditure, but will not be allowed. Section 145 of the Income Tax Act, ICDS, right? Accounting policy there will be there. It talks about gratuity valuation. Have a look at that. Clause 13 of 3CD gets filled up based upon whatever is the method that they have adopted for gratuity valuation, because they're asking you what is the clause 13 asks you for that question. Please look into that. Provision for gratuity is not created in the books or books of accounts. What is it that the tax auditor has to do? The tax auditor shall report. What you don't have nothing. There's nothing that you can do it in 3CD. But you ought to have done it according to the accounting principles. Therefore, tax auditor shall report the same and may be required to qualify his or her tax report in form number 3CA, 3CB. Please have a look that sometimes what is not called for in 3CD may require a comment in your audit report, may require a qualification in your audit report. Therefore, take care to ensure that some of these issues which violate an accounting principle gets reported in the audit report. Very important. You can't look at it in a disjoint manner. 3CA, 3CB, 3CD, all of them will have to be comprehensively looked at. Then you have to decide what goes into 3CD and what cannot find a place in 3CD. Is there a need for me to qualify that in 3CA or 3CB? Is a question that you should ask. So the tax auditor should call for the order of the Principal Commissioner of Income Tax, granting approval for the gratuity fund, verify the date for which it is effective, and also verify whether the provisions have been made as provided in the trust deed, rules and regulations governing. That's what is where you have to look at to say whether I should treat that as an allowable expenditure or not an allowable expenditure. Yeah. Any payment made by an employer towards the setting up of or formation of a contribution to any fund. Please understand. Let us say provident fund, let us say gratuity fund, let us say superannuation fund has been approved by the Commissioner of Income Tax. Then contributions are made into that particular fund. That is permitted. It's an allowable expenditure. But if you incur expenditure to set up those trusts, maybe pay a professional fee, maybe pay a registration fee, or somebody goes to the income tax department to get the approval, none of those expenditure will be allowed. None of us even look at this at all. So kindly take care that any expenditure, even subsequently also, suppose you have something to do for the trust and you do it, and it is paid from the company, that will not be allowed. Let us say audit fees of the gratuity fund is paid from the company or from the firm, will not be allowed. So that you should take care, and that you have to state in your audit report. For the details of payments which is not allowable, because it's not allowable. That's it. Contingent nature, I've already, what is, first of all, let's ask a question. What's a liability? What's a provision? What's a contingent liability? If you ask that question very clearly, liability is, it's known, ascertained, obligation is there, you have to make a payment. And anything that's going to be paid within 12 months, short term, beyond 12 months, long term. This is the principle. Now come to provision. Not everything can be a provision. What is it that we want to ascertain? We want to ascertain whether there's certainty regarding the amount or the timing of payment. If that is the case, and there's no certainty, but services have been received, no doubt about that. There was a contractual obligation, but the quantum of payment to be made could be uncertain. The time when it will be paid could be uncertain. Normally, in the case of provision, time is known, but quantum is not certain. So in which case it gets into a provision. Now let us ask the question, how is this a provision? For example, provision for depreciation. What is so uncertain about depreciation that is there? If you ask me that question, the useful life of the asset itself can get altered. You don't know, there is no certainty about that. And therefore, there's a provision. Taxation, yes, there is no certainty about this taxation because I may say something, the officer will decide something else. Therefore, it's a provision. Third, warranty. I don't know how many people will come for warranty service. They may come, they may not come. Then bad debts, provision for bad and doubtful debts. I don't know, I may go and recover it. Or the other party may come and give me the money. I don't have certainty. I will only say 10%, probably the whole of that will go wrong. Or I may say whole of that may go wrong, I may recover something. So whenever there's an uncertainty regarding the quantum, then you set that into a provision, very clear. Now, I understand that bills have not come, but I know it's certainty I have to pay this amount. Bills have not come, they put that into provision. No, quantum is known, certainty is there, except that a document has not come on accrual basis of accounting. It has to get into current liability and not a provision. The words are used so loosely without understanding the concept relating to that. Now, if you come to contingent liability, neither the timing nor the quantum, nor is there certainty whether I'll make a payment or not. There is so much of uncertainty surrounding. It depends upon the happening or non-happening of a particular event. And therefore, normally it is taken as notes to accounts rather than trying to debit that into the profit and loss account. Therefore, including in CARO, the tax auditor may also verify reporting under CARO and disclosing the notes on accounts. All that one has to take care and then report the contingent nature here. You also have AS 29, Ind AS 37, talking about contingent assets, liabilities and all that. ICDS 10. All the acts are going to speak about that. No disclosure is required. If it is in notes already, you don't have to do anything much. It's better that we report wherever it is required. That's my contention. 21H, amount of deduction ineligible in terms of section 14A. That means I've already said there's an exempt income relating to section 10 or any other exemption, agricultural income for which you have made an expenditure. Especially earlier, we had a problem with respect to dividends. Every time there was a dissonance on that, telling that it's an expenditure relating to that, so that I don't allow. No, if that is the case, now as far as dividends are concerned, it is set to rest because it's going to be taxable in the hands of the assessee. And if there is an exempt income, any expenditure incurred with relate to such exempt income will get disallowed. For example, you take partnership firm, it's after taxation, I get tax free. Now, when I'm filing my individual return, if I spend something towards that to earn that particular money, then probably it will get disallowed. We have to be careful about that. That's with respect to 14A. Then there's what is called as Rule 8D. What does it say? The amount of expenditure directly relating to income, which does not form part of the total income. The amount of expenditure directly relating to, this is a rule. That was a section, this is a rule. What does it say? How do you compute? Rule 8D says, how do you compute the disallowance? The total amount of expenditure directly relating to income, which does not form part of the total income, disallowed. That's one computation. Next, an amount equal to 1% of the annual average or the monthly averages of the opening and closing balances, because you have got something in the opening and closing balances, take that also into consideration. An amount, then take the annual average of that, do it on a monthly average, take an annual average, and an amount equal to 1% of that, it does not or shall not form part of the total income, provided that the amount referred to in clause 1, 2 shall not exceed, if I incurred an expenditure, not only the expenditure, but 1% more. You have to compute that. Opening balance, closing balance, do all that. That exercise is already given in 80D. Examples are also there available. Shall not exceed the total expenditure. What is the limit? See, for example, 100 rupees I have spent. The amount of disallowance after working out, but the total amount of expenditure, because you have to take a ratio. You have to take a ratio because some of that expenditure can relate to taxable income as well. Therefore, when you take the ratio, they will tell you, I may only get 80% of the total that will get disallowed, 20% will get disallowed because part of it relates to taxable income. But he says, if at all you want to disallow, maximum that you can disallow, telling that it straight away relates to non-taxable income, then whole of that 100%, you can't go beyond that. If your computation comes up to 120%, 130%, you can't do that. That's what Rule 8D says. It is not a mandate if circumstances prove otherwise and assessor is able to substantiate that it does not relate to non-taxable income. So I don't think this should be disallowed, in which case he has to litigate on that particular issue and take it forward. Earlier, we were not litigating because the amount that was there was so small that we used to ignore, not trying to put the effort to make a claim on that. What is tax auditor's function under Rule 8D? Because you may compute, you may understand, take a written representation, SFIAT. Sometimes you don't understand, so they have to give. The tax auditor will verify the amount of inadmissible expenditure as estimated by the SSE, or we may help him to understand that that's the estimated amount with reference to established principles of allocation of expenditure between expenditure based on logical parameters. How much of it should go to taxable income? How much of it will go to non-taxable income? And how much has been by way of turnover, maneuver spent, all that. So it has to go. And this requires proper estimates to be made by the SSE because his working papers will have to contain that. Attention is invited to standard on auditing 540, auditing accounting estimates, including fair value accounting estimates and related disclosures. So that's with respect to Rule 8D. Many of us don't look into that. That's why I thought let me speak a little more on that. Inventive under Section 3613, ICDS 11. The provisions of Section 3613 provide that the amount of interest paid in respect of capital borrowed for the purpose of business or profession would be allowed as a deduction computing the income referred to in Section 28 of the Act. In respect of capital borrowed for the purpose of business, please understand. The proviso thereafter provides that any amount of interest paid in respect of capital borrowed for acquisition of an asset, that will get disallowed. So you have to really you have to have the clarity when the interest is paid. Is it towards revenue expenditure or is it towards capital expenditure? And only when the asset is ready for use, Not even put to use. You don't have to go. Ready for use. Then capitalization stops. Then it becomes a revenue allowable expenditure. That has to be taken care. 21 is exhausted. Unless somebody wants to ask a question somewhere. I'm not really looking at any notes or anything. But then if there's anything, I think somebody can. Okay. Okay. Just I don't see any comments. But anyway, we can discuss this issue later. Then we have clause 22 relating to MSME Development Act 2006. What does it say? Section 23 of the MSME Act lays down that an interest payable or paid by the buyer compounded, and it will be for 3 times the normal rate of interest buyer under or in accordance with the provisions of this act shall not for the purpose of computation of income under Income Tax Act 19 be allowed as a deduction. Did you understand? I made a comment there. What did I say? Any interest that has to be paid, you have to deduct tax at source. I made a comment. So what does it mean? When I'm paying interest with respect to MSME, payments not made within the given time, then interest has to be tax deducted. Now, when the expenditure itself is not going to be allowed, why should I deduct tax at source? Is a question of the SSE. The answer to that is the provisions of tax deduction. As far as the deductor is concerned, he doesn't have to worry whether that is taxable, allowable, non-allowable. All that is not the criteria. He has to do it. Otherwise, he steps into the interest, penalty, other late fee provisions which are relating to that. And therefore, I will have to at least state that no tax has been deducted. Now, what can happen to the SSE? Anyway, this is not going to be allowed. So why should I worry of deducting tax at source? He can say that. But as far as the tax auditor is concerned, he must mention regarding this tax deduction done or not done. So take care. So what does it say? Section 15 of the MSME Act requires the buyer of, or that is the payments to be made to the supplier, requires the buyer to make payment on or before the date agreed upon in writing. First is, what is the date agreed upon in writing? Because a lot of them have got credit period. So it's agreed upon in writing, or where there is no agreement in this behalf before the appointed day. It also provides that the period agreed upon in writing, even if you have agreed in writing that I'm going to make the payment after 90 days, 60 days, you ought to pay it within 45 days. And that is the limit. And even if it is in writing that it is going to be beyond 45 days, you have to restrict it to 45 days and then make a disclosure in the financial statements. That if it is not done, then it is for the tax auditor to specify that here. That's the, so acceptance or day of deemed acceptance is one thing, 45 days. But if it exceeds 45 days, it must get restricted to 45 days. Yeah, steps to be followed for reporting under clause 22. Look at this. The auditor should seek information regarding status of the enterprise. That is, whether the same is covered under MSME Development Act 2006 or not. Status of the enterprise. Which enterprise? I don't have to be a MSME. I have to ask about the suppliers whether they're covered under MSME. And what did this buyer do? Did he make efforts to find out whether it's under MSME or not? The obligation rests on the buyer and not on the supplier. Right? So therefore, because he has to make a disclosure in his financial statements, therefore he should get this information. Then auditor should cross-check the disclosure made in the financial statements. You've got all the details. Look at those details and find out how many of them are falling under MSME, first issue, and whether the classification has been done. Obtain a full list of suppliers of the SSE which fall within the purview of the definition of supplier. Supplier under MSME Act. Verify from the books of accounts whether any interest payable or paid has been debited or provided for in the books of accounts and check for its veracity. How many things are there? One is understanding whether supplier is an MSME supplier. Second is part of disclosure, including notes to accounts as well as disclosure between non-MSME and MSME. Then not having paid within 45 days, then I have to make an interest provision. And next is whether TDS has been deducted or not. All these issues have to be looked at. So that's the function of looking at MSME payments to MSME vendors. Verify the additional information provided by the auditee relating to interest under section 16 in the financial statement. If on test check basis the auditor is satisfied, then the amounts are debited to the profit and loss account should be reported under clause 22. If no provision has been made or there is no disallowance as such, see, if no provision has been made, there is no disallowance as such. If provision itself is not made, where is the question of disallowance? It's not there. But it may have a reporting implications. That means your 3CA, 3CB should contain this. Or the statutory auditor would have reported that. Further, the disallowance happens when the actual payment is made. Okay, if at all it is paid, you didn't make a provision, no doubt. You just have to report, qualify, or whatever you want to do. But definitely, you will go to make a payment because the MSME supplier is going to ask you for that payment later. The time that you make the payment, it will get disallowed because it's going to debit the profit and loss account. Take care. Particulars of payments made to persons specified under section 48 to be. Who are those specified persons? Who are those specified persons? Relative of the SSC. Relative, widely defined. It could be director of a company, partner of the firm, or member of the association, or family, or any relative. There are a lot of permutations and combinations where the act has spoken. With respect to each of them, director, then who are all his relatives? Partner of the firm, or the firm itself, or the company itself, it goes on. Therefore, I have not exhaustively covered here because it's available both on the Companies Act as well as under the income tax law. Any person that is relatives, person here includes all persons any person who has a substantial interest in the business or profession of the SSC. Many permutations and combinations are possible, which is extensively defined. What all should you take and report? Serial number, name of the related party, PAN, Aadhaar number, type of relation, date, transaction, and the nature of transaction nature, that is nature of transaction and amount. Now, all of them will have to be looked at from the point of view of income tax to say what is a relative, how have they been defined, and then you have to report that. Now, maybe it's arm's length only, but still you have to report. It is for the assessing authority to decide what he wants to do with that. Now, I will not go deep into that. I've finished all the expense part of it. Now, there are investments which are made, right? Clause 24. Eligible expenditure and quantum of deduction. Now, they say if you make these type of investments, they are going to give expenditure of a particular type. That means they allow this, though of course the profit and loss account may contain this, may not contain this, but your computation will definitely take this into consideration. Sometimes 15% is allowed, sometimes 40% is allowed, sometimes 100% is allowed. If you do all that, then the question that comes up for the tax auditor is to understand what are the provisions of that particular section, then what are the conditions laid under those sections, and if conditions are accepted that it has been followed, then whether the amount of claim made is correct, and in case if the conditions are not fulfilled, then take it from me, it will get disallowed. And that's what it talks about, investment in plant and machinery, and they talk about amount of quantum of deduction they get. That is, it is additional to the normal depreciation that you claim. Then investment in plant and machinery is notified in backward areas in certain states. Then amount deposited in tea, coffee, rubber development account. So all this, what we have to do is understand the provision of the section, find out what are the conditions which are there. Third is find out whether those conditions have been followed, and find out the computation whether it has been correctly done. This should form part of a working paper, and therefore one has to be very careful to decide how much needs to be disallowed or how much should be allowed, or the whole thing because it does not fulfill a condition, whether it will get disallowed or not. So these issues have to be discussed. Reserve created of the profit of the SSC, 33AC. See, that was part of that only. It continued. You have created a reserve. Now the shipping business. Now the shipping business gets closed down. Let's understand that. It could be for any business for that matter. The tax auditor is required to report the deemed income chargeable as profits because it did not fulfill the condition. Section 30 is the allowed deduction in respect of reserve created of the profit of the SSC engaged in shipping business to be utilized in accordance with the provisions of subsection 2 of section 33 AC. Now, it does not follow that, or the business fails, and therefore the conditions are not fulfilled. If those things happen, it is for the tax auditor is required to report the deemed income chargeable as profits. Clause 24 requires disclosures of amounts deemed to be profits and gains. Deemed to be profits and gains. It's actually an expenditure. There was an allowance, and by virtue of not fulfilling the conditions, it has become income, taxable. Clause 24 requires disclosure of amounts deemed to be profits and gains under Section 32 AC, 32 AD, 33 AB, 33 ABA, 33 AC. All that I've defined here. Investment in plant and machinery, investment in plant and machinery in notified backward areas, amount deposited, where an amount is being deposited by an SSC for anything and reserve is created, all that will come under this. Okay. So therefore, we have to be careful. It may get disallowed. First, I did not take any of these, thinking that it may not be required. It's because regarding investment, but I know the consequence of not following the requirements, and therefore the section can fail. I come to clause 26, section 43B. Good amount of debate can happen here if at all somebody is interested, because this going to deliberately be there in most of the tax audit issues for the reason that taxes have not been paid or interest has not been paid and all those issues. Wherever liquidity issues are there, this can arise. So in respect of any sum referred to in clause A, B, C, D, E, F or G of section 43B, the liability for which pre-existed, I'll come to ABC, we'll look into that. Pre-existed on the first day, that means it was there as a liability. I did not discharge. Pre-existed on the first day of the previous year, but was not allowed in the assessment year preceding because 43B did not allow. That is one. And was paid during the previous year. Earlier year I did not pay, I paid during the previous year. For example, it could be TDS, for example, if you take. I don't want to relate that to 43B. I'm telling you, if it is paid, the year of payment you get. Same way, 43B also is there. Paid during the previous year, not paid during the previous year. These are the issues that we need to check. Was incurred in the previous year, incurred, and was paid on or before the due date of filing, furnishing of return of income, permitted. Not paid on or before a aforesaid date, not permitted. It will go to the year in which actual payment is made. So they give you a leeway after 31st March of that financial year to go up to the date of filing of return of income and then make payment will still be allowed. All these things we'll have to take into consideration for the purpose of reporting, because the assessing authority should not spend time on some of these issues. State whether sales tax, customs duty, excise duty, or any other indirect tax, levy, cess, impost, etc. is passed through profit and loss account for which payment has not been made. That's where we will have to come into picture to disclose that. The following amount shall be allowed as deduction in computing the business income of necessary in the previous year. That means actual payment basis. You'll have to go. That's what leads to deferred taxation, because what is not allowed in 1 year is a business expenditure for the purpose of Companies Act will get allowed subsequently, timing differences. Therefore, deferred tax, all these issues will come up. The following amount shall be allowed as deduction in computing the business income of an SSC in the previous year in which such amounts are actually paid, not when they are provided, not when it is a liability. Right? Any tax, GST, sales tax, value-added tax, service tax, excise duty, municipal. See, don't restrict it to only the commercial part of it. You got municipal tax, property tax also to be taken into consideration. Duty, cess, or fee, by whatever name and called, payable by the SSC under any law of time being enforced, all of them will get disallowed. Then, any sum payable as an employer by way of contribution to any provident fund or superannuation fund or gratuity fund or any employer's contribution will come under 43B. Employee's contribution, if not paid within due date, will get disallowed completely. Please be very careful. Don't mix up. All the judgments now has fallen because of the amendment which has been brought into as a explanation 5 under 43B. Any bonus or commission payable by the SSC to its employees for services rendered where such sum would not have been payable to him as profits or dividend if it had not been paid as bonus or commission. That's again a dissolution. That's a complete dissolution. Any bonus or commission payable, there's no bonus or commission which is payable and ought not to be paid as profits or dividend, because that was discussed already. If it had not been paid as bonus or commission, it will get disallowed, and it will get allowed only when it is paid, subject to the condition before filing return of income. If you file, you still get the benefit. Interest on any loan or borrowing from any public financial institution, a state financial corporation, or a state industrial investment corporation, payable in accordance with the terms and conditions of the agreement governing such loan or borrowing. Please look at that. You will have to look at that instrument and then take care. That's an important issue. I've got a lot of things to discuss on 43B. As soon as I finish this, I'm going to take, there are a lot of court judgments and we can rely on that to take a stand. Then any sum payable by the SSC as interest on any loan or advances from a scheduled bank or a cooperative bank other than a primary agricultural credit, just forget about that. We just say any sum payable to the SSC as interest on any loan or advances from a scheduled bank or a cooperative bank. Then any sum payable by the SSC as an employer in lieu of any leave at the credit of the employee, leave encashment, make a provision, actuarial valuation, none of them will be allowed. Any sum payable by the SSC to the Indian Railways for the use of railway assets, newly introduced, will not be allowed. Only on the date of payment it will be allowed. There was is a list of allowable deductions subject to payment. It's not disallowance. They say time being I will not allow you, but the year or the day on which you pay, I will take that for the purpose of allowing. Sometimes some of them are allowed before filing return of income, otherwise it goes to the next financial year. So what all should you do? Tax audit in his audit report should therefore clearly distinguish the liability incurred during the previous year in respect of all the specified sums referred from A to G, which I've already given you, from the liability that pre-existed. Say it's not a provision, it's a liability that pre-existed on the first day of the relevant previous year, and then start looking at it to say whether any payments are made or not. And what is the end, at the end of the year, what is it? All that we'll have to check, and then try to prepare a table and keep the working papers with us. Prior paid items, contentious issue, but it's all clear. Lot of judgments now. Prior paid items, no section deals with prior paid items. You look, there is no word prior paid items at all in any of the sections. Either as allowable between section 30 to 37 or as disallowed under section 40 to 48. They don't speak about prior paid items. Is it allowed? Is it disallowed? If you ask that question, section 43, which is allowable only on payment basis, again doesn't speak of this. So what has happened? Prior paid expenses, no deduction if there's no evidence that expenses had been crystallized during the year. Principles of crystallization is to be fulfilled. ITATs have already held, and many of us just simply disallow. Reason being, suppose if you go back and stand when that expenses had to be taken into the financial statement, if you had the information, if you had the data, then and then you come back, you forgot, or you did not understand, or you did not do it, you did not book that as an expenditure, and then you realize and then try to do it in some other subsequent year, you have to, then in which case it will still be a prior paid expenditure. Reason being that you ought to have known at that particular point of time. But if you come back and then say, no, I could not have known because there were so many steps to be taken, it has got crystallized only during the current year. For example, arrears of salaries. Though I know arrears of salaries have to be paid, but where is the computation? So there, if the crystallization takes place in the current year, then it will not be a prior paid expense. Though, of course, in accounts, somebody can classify it under prior paid expenses, but it will not be a disallowed expenditure where crystallization is to be fulfilled. If it is fulfilled, all the ITAGs have held that it's an allowable expenditure, otherwise no. Okay. Now let me go to, I think I've spoken regarding most of the issues. Can we get back? Let's see if anything is remaining. Then I think this is the last. Okay. Now I've covered about 60 slides. What time is left for me? Can somebody tell me? Is there time that is left for me?
Still half an hour.
Or should I close now and leave room for somebody to ask a question?
We have half an hour, sir, more.
Oh, very good, very good. Then I'll go to 43B and look at the type of judgments that have come. And review of tax audit report somebody has done. Some of those issues I'll cover if time permits, but otherwise Word document, Word document. Okay, just give me some time. No, this is correct. I must share it. It's taking time. Yes. Yeah. Issue with respect to section 43B. One by one, have a look at it. Okay. If under the sales tax, you have to share. Please share it. Yeah, is it visible? Is it visible?
Yes, sir.
Okay, right. I'm going forward. Have a look at the plethora of judgments that have come. Very interesting. If under the sales tax legislation applicable, if sales tax, now look at it as GST, so deferred, there is a deferment. Please look at that. So deferred is treated as actually paid, then statutory liability shall be treated to have been discharged for the purpose of section 43B. What does it say? It says the state government has given me a permission to treat it as a deferred tax. I'm going to make the payment as of now the law, the state law permits me to do it. In which case, circular number 496 dated 25/9/2087 also allows this to happen. The apex court in the case of CAT versus Gujarat Polycrete Private Limited has held that state government may amend its sales tax act to provide that the sales tax deferred under an incentive scheme framed by it will be treated as actually paid so as to meet the requirements of 43B. Though not paid, but it has got deferred, and therefore, if by law it is deferred, it is deemed to be paid. So that's the issue. Next. Some state governments, instead of amending the Sales Tax Act, have notified schemes under which sales tax is deemed to have been actually collected and dispersed as loans. Right? It's not deferral. It's deemed to have been collected and dispersed as loans. The amount of such sales tax liability deemed to be converted into loan may be allowed as a deduction in the assessment for the previous year in which such conversion has been permitted. That means I have not paid. But then the notification allows me to convert that as a loan. I treat that as a loan in my books of accounts and it is deemed to have been paid. So it will be allowed. Circular number 674 dated 29/12/2003 and also held in Gujarat High Court in the case of CAT Gold Lux Silicate Industry held that where sales tax due to the government is converted as loan to be repaid by the assessee subsequently by installments, it would amount to actual payment of sales tax in the year in which it is converted itself, not when there is deferral payments being made. Then the apex court in the case of CAT versus McDowell says furnishing of a bank guarantee in respect of any sum payable by an assessee cannot be equated with actual payment as required under section 43B. Their deferment conversion was accepted to be paid. But if I give a bank guarantee, the courts have said, the apex court, Supreme Court itself has said, giving a bank guarantee because it is a unilateral act, not the act of the other party who should receive it. Therefore, such unilateral act of trying to say I'm going to give you a bank guarantee in respect of some payable as I say cannot be equated to actual payment as required under section 43B. It was further held that bottling fees, look at it, very interesting. Bottling fees payable for acquiring a right of bottling of IMFL, which is determined under Excise Act and rules, is neither fee nor tax, but it is consideration for grant of approval by the government in respect of exclusive right to deal in bottling of liquor in all its manifestation, and consequently, bottling fee payable under excise law for acquiring the right of bottling IMFL does not fall within the purview of 43B. So what does he say? He says, you look at the act, look at what are all allowable or what are not allowable, exactly you have to speak according to that. If there is some other activity which does not fall under the provisions of 43B, you have no right to bring it under 43B. So you have to be very clear, study those and then structure it in such a way to find out whether it falls there or it doesn't fall there. That's all. Very clear. The words that are there have to be understood in all its sanctity. That's important. And it's just not for this. Please understand. There are many provisions where you have to read it very carefully to say whether it will fall there or it will not fall there. And reading of that, understanding the language is an important issue. And lot many of us do it in such a hurry. The reason why we do it in a hurry, let me be very honest. All of us want to accumulate by doing great amount of work on files. No problem. Do that. But then build your office structure to attend to all these issues. Very, very important. It gives you so much of satisfaction at the end of the day that you understood what you have done. First issue. Second issue is we do not know how to charge. Our problem is that. Why are we trying to hurry? Because we want small payments will come. But if you know what type of work you are involved in and you know the seriousness of the work, you should demand for it. Otherwise, don't accept the assignment. And that's where people are failing. Either see, I've been with associated with management graduates. You know who they charge. Reason being, they are very clear. They are very, very confident of what they're saying. And they know what they're saying. Otherwise, they refuse the assignment. Now that should be our method of working. And please understand this, that it requires so much of seriousness, so much of commitment, and definitely over a period of time, you will see good people coming to you because they're willing to pay you more. Take it from me. And I speak that from Bangalore. I don't know about other places, but in Bangalore, people are of that type that you give good service, they're going to pay you well. That's my, at least, understanding of my practice, that they pay you really well. Otherwise, I'll say I'm not interested. That's it. Okay, take care. The Apex Court, in the case of Mineral Area Development Authority and others, has held that royalty is tax. Thus, royalty payment outstanding as on the balance sheet date. What did it speak at that time about royalty? Any payment of that type paid by a public sector undertaking to the government, state government, is not an allowable expenditure, but not with respect to others. Royalty is a tax. 43B says, if you have not paid that royalty to the government, then in that case, please treat that as 43B. Thus, royalty payment outstanding as on the balance sheet date shall be considered relevant for the purpose of section 43B. Then I go further. See how many cases are there, very interesting cases, and therefore gives a lot of insight into how 43B has to be looked at, because it's an everyday litigation for us. Berger Paints, Supreme Court again. The entire amount of excise duty, customs duty paid by the assessee in a particular accounting year is an allowable deduction in respect of that year, irrespective of the amount of excise duty, customs duty, which is included in the valuation of the assessee's closing stock at the end of the accounting year. Did you understand that? What does it say? I may include that as a part of the closing stock, section 145, ICDS. There you have a particular method or a treatment. Then it says, whether you put that into your valuation of inventory or not, I'm not bothered. I just ask you whether you are paid. Now, the assessing authority can come back and then say, oh, you did not include that in the inventory, I'm going to disallow. Says, no, you cannot disallow. 43B says so specifically that whether you are paid or not how you treat that in the books of accounts, and therefore it has been allowed. Then MP High Court, Mandi tax, look at that. Though it is called as tax, Mandi tax is not a tax. It is paid by the trader who enjoys the facility of Mandi. He enjoys a facility. It is not a tax because it's some association there which is collecting that, enjoys the facility of Mandi because some services are provided with Mandi, and therefore that cannot be taken as a tax, as the same is collected for services rendered. So therefore, what does it call for? If you would like to really look at it so carefully to understand the concepts so that you know how to interpret a situation. Then 43B starts with non-obstinate clause. What is non-obstinate clause? Notwithstanding anything contained in any other provisions of the law. That means it overrides everything else. 43B becomes important. So, which means irrespective of the accounting treatment in the profit and loss account drawn for the previous year under consideration, following mercantile or cash basis of accounting, guidance note also says that. So also look at under section 140 of the Income Tax Act, deduction 43B is allowable only on payment basis, irrespective of your accounting treatment, irrespective of your section 145, irrespective of all that. Guidance note says, please look at what are the provisions of section 43B and go scrupulously according to that. Okay. Emoluments in the nature of good work. Look at that. Emoluments in the nature of good work, reward, incentives, or ex gratia. Emoluments in the nature of good work, reward, incentives, or ex gratia are not bonus or commission as contemplated in section 36(1)(2), but are deductible under section 37 of the Act as held by Delhi High Court. Look how the whole nature, the method, the process, the thought process has changed completely. All of us would have gone as though it is bonus. But no, then look at it very carefully to find out whether it's bonus at all. What is bonus? Why is there a bonus? Bonus is that your total period of 12 months, because of the 31 days, 30 days and all that, you still have another 26 days which gets covered. You've got 13 months, but they hold it as 12 months. And that one additional month or 26 days that comes in is paid as bonus without having to look at anything at all. But if it comes by virtue of an act, then it cannot be a bonus. It should be relating to that particular act, and therefore it doesn't become part of bonus. Circular number 7/2006 observes that the clarificatory explanations only reiterate the rationale that conversion of interest into a loan or a borrowing or advance does not amount to actual payment. There's a circular. It says tax as such, if it gets converted into a loan, is not 43B disallowance. It will be treated as allowance only in that particular year of conversion. But if it is interest and it becomes a loan, there they say it still has the character of actual interest, and therefore, as and when installments are paid, so much portion of interest relating to that you have capitalized, that is, you have converted that into loan, will still be on actual payment basis. It cannot go because it just get converted. See, the concept itself has changed here with respect to interest and with respect to taxes. Okay, so these are all issues which I thought was interesting, and I carried it for you. Now I think I will have a look at one more issue. Can you look at that? One last issue regarding, I think I have, with respect to what is the review made, where all mistakes can be made by tax auditors. Okay. Review of tax audit reports. Yeah, let me share it here. This is the last part. I think I'll conclude after this. Yeah, I think the sharing is there. Visible?
Yes, sir, it is visible.
Yeah, thank you. Now I go forward. While reviewing various tax audit reports, it was observed that in some cases, how to move that top. Just a minute, I'm trying to adjust so that you'll be able to, otherwise you go back to the smaller version. Okay. I don't have to be visible. It is better that we have this. While reviewing various tax audit reports, it was observed that in some cases where the assessee had obtained a separate audit report, please understand this, separate audit report, reference of that separate audit report for claiming deductions was not made in form number 3 CA as per the requirements of para 28.2 of the guidance note. What does it mean? The statutory audit is different, and then the tax auditor is different, and we have to give reference to the separate audit report done by somebody else. If I have done it myself, it's fine. But if it is done by somebody else, while reviewing the various tax audit reports, it was observed that in some cases where the associate obtained a separate audit report, statutory audit being different, reference of that separate audit report for claiming deductions may have been allowed, but the object of trying to give reference to the separate audit report has to be in the tax audit report. I don't think they can disallow on that basis, but to make it much more professional, you will have to invite reference to that, and because you're going to depend on that, therefore you'll have to, and this is as per the guidance note of the Institute of Chartered Accountants of India, para 28.2, right? While reviewing various tax audit reports, it was observed that the companies which are required to get their accounts audited in Companies Act 2013 had had selected option clause 44 AB within bracket A. That means it referred to 44 AB, but it is not 44 AB. It is especially with respect to companies, societies, trusts, which ought to get their accounts audited by under any other law. It is not 44 AB. You will have to bring about third provision to section 44 AB, which would mention about audited under any other law and not audited under section 44 AB. Please understand that. They're expecting that to be stated as clause 3 and not as clause 1. So that's the intention. Third proviso says that. Right. Next. See how interesting. Smaller issues, but qualitatively very firm. Then, while reviewing various tax audit reports, it is observed codes for business or profession for all main activities were not reported. Why did you not report? Sir, I did not understand where it should fall. Why you should worry? Go where they could be located clearly from the annual report. In the annual report, you are going to have the codes. Please use those codes. You don't have to search anywhere else. It's part of the annual report. Right. And especially if the tax audit and statutory are the same, I don't see any confusion here. And in spite of that, we have seen tax audit reports where this is missing. It is contained in the statutory audit report, but it is not contained in the tax audit report. Expenditure incurred at clubs being entrance fees and subscriptions was clubbed with expenditure incurred at clubs being cost for club service and facilities used and reported together under subclause. No, the clause is asking you for a split up. If you don't do that, then the sanctity of trying to fill that particular form is gone. The two expenses are to be separately reported as per the requirements of the prescribed format. Why don't we be sensitive to that? Then penalty or fine, I already discussed. However, the same were to be separately reported in different subheadings as per the requirements of prescribed format. Late filing of TDS. Paid during the year was reported under this subclause under subheading as any other penalty or fine not covered above. See, late filing fee is not a penalty, is not a fine. Should not be reported here. Okay. As per MCQ on late filing fees and penalty posted at the link of the income tax department, in respect to late filing fees under section 234E, it has been stated, it should be noted that rupees 200 per day is not penalty, but it's a late filing fee. Thus, the same is not required to be reported under this clause. Lot of tax audit reports are reporting it here. Then we talk about, while reviewing, in some cases, a consolidated sum is in respect of provision for various expenses. Look at that. There's a provision. People have consolidated that of sundry parties were reported. Instead of the date of crediting the amount of provision in the books of accounts at random, dummy date was reported in many cases. Why don't you give a split up regarding different activities and different nature? That's expected of us, that you cannot give a consolidated figure. Why are we giving a consolidated figure? We don't, because there could be a lot of entries and we don't want to exercise that. If at all you want to do that, then at least you say somewhere that it is a consolidated amount and there are details regarding the split up. Reporting under this clause is required separately for each of the individual payee. They want the name, they want the PAN number, they want the Aadhaar card. Consolidated reporting for the heads under which tax has not been deducted has been done in certain cases. No, it requires payee wise. It requires section wise. What type of section? Because they ask you those details. Where the reporting has been done on the basis of certificates from the SSE. So look at this. Where the reporting has been done on the basis of certificates from the SSE, the fact was not reported as an observation in clause 3 of form number 3CA and clause 5 of 3CB, as the case may be, as required by the guidance note. You got standards on auditing, you got guidance note, you got ICDS, you got the tax audit format itself, asking you specific questions, and in spite of that, we ignore, because no action has been taken either by the department or by anybody else. And there are people, even each one of us are given 60 audits. Let me tell you, doing it sincerely and for larger companies, you won't be able to do even 10 or 15 correctly. And a lot of people have done even beyond 60. Right? Institute has taken action. That's a different issue, but let's leave it at that. The observation qualification of this clause were provided in the notes attached to Form 3CA. However, the same should be reported under Clause 3 of Form number 3CA or Clause 5 of Form number 3CB, as the case may be, as required by the guidance note. Guidance note is exhaustive. A lot of issues are available there. Different situations are explained. It was found that reporting under this clause was done for the provision created in the books of accounts. Why? In line with the requirements of guidance note, any liability of contingent nature debited to profit and loss account is to be reported. It has to be reported in contingent liabilities only. Contingent liabilities which are mentioned in the notes to accounts are not to be reported here, as they are not debited to profit and loss account. Please take care. Only if it is debited to profit and loss account, you need to report. If it is in part of notes to accounts, there is no reporting required at all. While reviewing various tax audit reports, it is observed that where the auditee has provided for or paid any interest payable under MSME Act as per audited financial statements, same was not reported under this clause as an amount so inadmissible under Section 23 of the MSME Act. We all take it for granted, put it into computation and leave it there. But we don't want to put that into the tax audit report. Why? Now there is a divergence between your computation, and many of them have not taken that into consideration. That's a different issue. But you have a divergence between your computation and that which is contained in the tax audit report. Then, in certain cases, name and PAN of the person specified under Section 48(2)(b) were not reported. In certain cases, the amount reported under this clause did not match with the amount as mentioned in the annual report. You have certain figures in the annual report. There can be implications. What is contained in the annual report can have implications on CARO, can have implications on tax audit report. Kindly have a look at that and then try to bring them wherever it is required. In certain cases, consolidated figures were reported instead of respective transactions with respective persons as per 48(2)(b). The amount mentioned in annual report, which is chargeable to tax under section 41. Oh, I didn't cover that section 41. 41 is that which will become income in the year of actual receipt. That means you are allowed a deduction. I kept that as a separate slide because the number of clauses were more. Principally, what does it mean? That you have got expenditure allowed because you thought bad debts would not come back or something would not come back, and therefore you wrote it off after making efforts, and they have allowed that. But after some time, you start getting that money back for whatever good reason. Then in the year in which that money is received, needs to be reported and it will be treated as income. Even if the company is closed, taxes have to be paid on that. So section 41, reportable under this clause, was not reported in many cases. That means it got treated as income. It is there in the profit and loss account. It is there offered for tax, but we did not report that here. That means the question is that what the department after all gets, sometimes it so happens that that particular money which comes in gets into the liability part of the balance sheet. It should actually be an income to be paid. No, it's for the tax auditor to look into that and report. That's why they're asking. And reportable in this clause was not reported in many cases. It is, for example, scientific research. A lot of investments were made, expenditure allowed. It was sitting on the balance sheet. Now, subsequently, some of them are sold. Now, you know what people have done? They have credited the capital account. No problem. You are not paid tax. Maybe the computation part in the income tax may allow you under block of assets, but you need to report that there was something like this. That is why they're asking you, because there are many clauses relating to this money coming back, and you have to report, either pay tax or adjust it against any other thing. But then it has to be reported so that the assessing authority has got the mind to ask whether it should be taxed or not. It is to be noted that as per the guidance note, the same is required to be reported irrespective of the fact whether the relevant amount has been credited to profit and loss account or not. It could have gone into a capital expenditure account. In spite of that, you have to report. And a lot of places you put yes or no. That's not expected. While it says cases when excise duty was passed through profit and loss account, whether it's passed through profit and loss account and to what extent, and little bit of highlights on that. Simply people say yes or no, and that they don't accept because the guidance note also does not accept answers like yes, no, not applicable. You have to state something. You have to apply your mind and state it. In few instances, the computation shown under the clause was incorrect. That means opening balance consumed during the year, then credits received during the year, closing balance, that computation is required, was not shown correctly. On few occasions, non-reporting of SENVAT utilized. SENVAT now it will be input tax credit utilized, and the treatment of the same in the profit and loss account were noticed. In certain cases, even where treatment in profit and loss account was reported, reporting of treatment in the accounts for opening and closing balance of SENVAT credit was missing. So these are some of the issues. So how do you overcome this? Looking at the clause very carefully, understanding the business of the client very carefully, talking to the client systematically, getting our working papers correctly, and then saying how to attend to it when clauses come to you for discussion. Then reporting of inadmissible amount on account of non-deduction of taxes for resident 30% as well as non-resident 100% are to be reported appropriately under respective subclauses. All of them are clubbed. This is or not done in few cases. Instead of reporting of details of resident payee, details of non-resident payee were reported under clause 21B2A. Similarly, instead of reporting of details of non-resident payee, details of resident payee were reported. Complete address of the payee was not reported in certain cases because with respect to non-residents, we may not get correct, but you should know how to collect it. It is important. So these are all the issues that I've had. And I think I've completed my total discussion. Unless somebody wants to ask any question, please do so.
Hi, sir. I have a doubt. There is this concept where cash payments exceeding 10,000 are disallowed.
Yes.
So in that, I wanted to understand two things. First one being, say there is a company which has like 10 business functions, and each function has 10 different manager, and there are petty cash or impressed cash accounts assigned to each person.
Agreed.
They make cash payments, and how that can be tracked, that being
okay, wait, one by one.
Yeah.
What really happens is, it has happened in my case as well, that the amount is transferred to the employee to spend, right? The employee takes the money for spending, it goes into his account. Am I audible? Am I audible?
Yes, sir. Yes, sir.
Okay. And he spends it in cash. And then what does he do? For the advances drawn, he is going to render his accounts and a journal entry is passed, booking the expense. And then this is a method in which cash payments, not to be reflected in the books of accounts, are going to get this method of routing the money through employees. It's a method. Tax auditor is bound to either get a proper reply from the management wherever you come to understand that there are cash payments, or ask them to state that. And we in our audit report will have to say the method that has been adopted with the company does not reveal whether payments have been made in cash or not. And therefore, I'm unable to express my opinion because they have used a routing method for the purpose of booking expenditure. I have to be categorical. Am I clear?
Yes, sir. Yes, sir. That was
Very clear. That is a method, a ruse to prevent that transaction happening in the books of accounts, which as tax auditors, we are bound to report.
Okay, sir.
Right.
And I guess same would be enough for the second query also. I had how reimbursements would be taken care of. For example, for the official work, the employee or any other person might have spent any amount exceeding 10,000. We cannot track whether it is cash or bank, and then later they can take reimbursements from the company. So that and all, how would be
Either way, the answer is the same.
Yeah.
Management has to defend that to say there was no cash payments. One, otherwise we qualify a report to say we did not get adequate information to support our view. That's all is our job. But we have to get that in writing. Please don't take on any oral methods, will not work. You have to keep that and then take your stand.
Okay, sir. Thank you.
Right. At least if you don't ask a question, I only want to understand whether the discussion I've had with you was interesting, was it useful? So at least to that extent, I would like somebody to respond. Yeah, I'm through.
Hello, sir.
Yes, please.
So,
Please go on.
Ravi sir, good evening.
Good evening. Good evening. Yes.
Yeah, this is Tupadia,
Yeah.
Chairman, Bangalore branch,
Yes, sir.
SICASA.
Yes, sir. Yes, sir.
Thank you, sir. Thank you for taking up this session for the students.
Yeah.
It was really a great help for them. Yeah. All of a sudden, you have taken it up, and we are really indebted to you for accepting this at the last moment. Yeah.
Yeah.
Yeah. Thank you, sir. From my side, I'm wholeheartedly thankful to you.
Thank you. Thank you very much. It's
Yeah.
more interesting because
Yeah.
they're youngsters, upcoming professionals.
Yes, sir. Yes.
So long as that integrity is there, sense of integrity is there,
Correct.
human values will be carried forward.
Yes.
And that's why I keep speaking at different forum to just tell people do the things rightly, and I know we are going to be successful.
Yes. Yes.
Okay.
Yeah. Sumitra, anyone wants to ask any questions? Just raise it up for the sir, or else you can give the
sure,
word.
sir. We'll check.
Yeah.
Yeah. Thank you.
I think all are done, sir. And
Right.
thank you so much, CA Ravi, sir.
Thank you.
It was great listening to you, to be honest. And thank you so much for hosting a session on the tax audit, which was organized by SICASA Bengaluru, and for your valuable time from your busy schedule, sir. Thank you once again, sir. Thank you so much, sir. It was great learning today.
Yeah. Thank you all. Right. I think I'll.
And thank you, everyone. Thank you everyone for being here today. making this event a good one and learning a lot of the things. And this is not ended today. We also have tomorrow and day after tomorrow, that is the third and fourth day of the tax audit. And you all can join at the same time, that is